Thanks, Chrissy, and morning all, and well done on getting up early. It's always a bit of a challenge, I know, especially being in the equity markets in Perth, where we, for some reason, don't have daylight saving. So if you're working in a place like Macquarie, then the morning meeting is about 7:30 Sydney time, and if you take 3 hours off that, you can work out what time you have to get up every morning. So well done. It's certainly not that early, but we'll get kicking on this. So what I thought I'd do today, and sort of just go through, what the battery materials market's done in the Aussie market, and obviously there's 50 companies here presenting over the 3 days, and just to provide a little bit of a landscape for where those companies are, where they've been, and sort of what this whole battery materials market has done to the landscape in the ASX in particular. So this is not a great chart, but it's basically everyone who's presenting this year and how they've gone over the last 12 months, and as you can see, it's been pretty tough. I did have to remove Mr. Rivera from this chart because when he's up 1,000%, it sort of skews the axis a fair bit. But certainly the uranium places, names have been quite good. There's some good development plays there, but I think it shows you that if you make a discovery that's material, it doesn't matter what the commodity price is doing in reality, that you'll just get a lot of value. But if you're sort of working on an asset that's understood, then you do become beholden to what's actually happening in the shorter term on some of these commodity prices. So it has been a tough 12 months, but if we move forward to what's happened in 2024, it's starting to get a little bit better. The axis is certainly shrinking. I mean, these numbers are still plenty of companies in negative territory this year, as there's been a pretty strong sell-off in the first quarter, but we are seeing a little bit of glimmer of hope there. I mean, I think the stronger performance from last year, particularly in the uranium space, that sector's been continued to be strong, and NextGen continues to advance its project, and it's helped them be one of the better players. But we are starting to see, a bit of a broader recovery across a number of different areas through base metals as well, which has been quite encouraging. And then when we look at the last month, it's starting to look better. So obviously coming off a fairly low base here, but we're getting momentum across the whole sector now. There's plenty of things that are now up and up pretty reasonably in the last sort of 3 or 4 weeks. 2/3 of the companies here are all up. So certainly encouraged by all of that. And particularly the breadth, I think. It's not just lithium going up or base metals, it's a bit of everything. It's rare earths are going up. We're seeing a decent recovery across the board, and I think as a couple of presenters yesterday indicated, lithium prices particularly have probably bottomed. We saw Albemarle overnight with a decent spot price sale. So those sort of negative momentum stories are slowing, and in fact have turned to the positive. And similar for the copper space. I think the outlook on copper particularly, and I think Scott touched on that yesterday, the ability for the world to make enough copper to actually undertake this entire decarbonisation of the global power grid is going to be quite challenging, and that will flow through to most of these battery materials in our view. So when we look to the commodity prices, I mean, this is the chart on the left is sort of where I always like to point people to. I mean, in general, these commodity prices they do benefit from inflation. Obviously, it's pretty skewed by what's happened with uranium prices and the low they came off, but most commodity prices, through a cycle are generally pretty heading in the right direction. I mean, you can start with gold prices, which just track inflation, and they generally just go up every year on average once you smooth normal month-by-month volatility. But certainly these battery materials names, if you're up sort of 50, 60% over a 5-year period, I mean, it's a pretty good return if you can roll that into the equities, particularly when you think about anyone who's producing a commodity generally has 2 to 3 times leverage to that move. So you're going to start seeing some pretty significant moves in value. Obviously, the chart on the right, though, just highlights that it has been pretty tough in the short term, and that's the reason that a lot of companies have struggled, is we've just had this negative momentum across a lot of the battery material space, particularly in lithium in the last year. So that's been the sort of, I guess, hit a peak. So we're at the peak this time last year almost. So we were coming off what was extraordinary pricing through the back end of 22. And hence the percentage numbers look quite aggressive, but in reality, coming off that low, and we'll start moving forward, I think we're going to start seeing a much more bullish outlook across all of these battery materials. And what will start to emerge, I think, is really the supply difficulties. Mining these things, developing them, getting approvals across the globe in different countries is far more difficult than anyone ever anticipates. I've been looking at commodities for over 20 years, and I hark back to 2010, 2011 when the world decided that iron ore was finished because BHP, Rio and Vale were adding tonnes in Australia, and none of them hit any of their targets, and these companies are basically unlimited on funding, and they still couldn't do it. And we had a bull run in iron ore for a decade, which is still going now because the supply just never arrived. So to think that we can do the same in some of these smaller, more difficult metallurgical commodities like things like spodumene and lithium and rare earths and these sorts of things, and actually deliver on targets is arguably farcical in my view. So I think that we're going to see an ongoing story of just supply disappointment, pushing markets into deficits, and we'll just see continued price spikes and more volatility in this space as we try and increase the scale of these markets. I mean, if you look at anyone's targets for EVs and battery storage, I mean, the lithium market needs to quadruple inside of a decade. I mean, it's just, I don't know, it's going to be pretty hard to do. So it would just create a lot of volatility as expectations move around from being oversupplied for a very short period of time to supply deficits, as we've seen in the past in plenty of other commodities. So we look in the very short term. Again, the start of the year has been pretty tough, but if you look at the last month, as I suggested, sort of everything's starting to go up pretty much, so it's looking quite encouraging that we're starting to see some decent moves across the board. So certainly to suggest we've come off the bottom, I think that chart on the right would just demonstrate to you that we are off the bottom effectively, and it's all looking quite encouraging. I think there's a few laggards there on the right hand side, but rare earths still heavily controlled by China in terms of supply. They're probably the bigger laggard, I think, out of most of this space, and obviously uranium and iron ore have had such a good year last year that it doesn't surprise anyone really. They've ticked back a little bit, but when you look at the share price chart, or the chart for those commodities, it's a blip to the downside more than anything else. So yeah, certainly encouraging signs across the board. So what I thought I'd do, looking at the Aussie market, obviously the lithium space has sort of come out of nowhere. If you look back a decade, these companies barely existed. I mean, Min Resources was a mining services and iron ore business, but between the four bigger ones, they've certainly become quite large players. The market caps have soared to sort of peaked at over 50 billion combined between the three of them. And probably the interesting thing is, as you can see, they ran with the lithium price really hard. But the biggest intriguing thing, and as we get through some of these other slides in comparison, is that the market at the big end has been happy to look through the lithium price fall and the trough that it's hit and now come out of. Min Resources is a little bit different because it does have a big iron ore business, and that's obviously been a massive benefactor for them. But in reality, Pilbara is just pure lithium, and IGO is pretty much the same, to be honest. And they've also really held up reasonably well in comparison to what we've seen in the commodity price. So when you think about big long-only funds in Australia that struggle to put money to work at the best of times, they're happy to hold big positions in these names, thinking they'll look through it on a 3 to 5 year view. And implies that the lithium prices are heading back to somewhere in that 20 to 30,000 range based on where the share prices currently are at the moment. So that's pretty much what you need to plug in to get the current share prices in terms of evaluation for a lot of these bigger stocks. So that's where I think the broader market still prices lithium in the longer term. But when we look beyond some of these bigger ones and look at some of the smaller ones, I mean, lithium's a little bit different because we had Tony at Azure and obviously Liontown sort of emerge out of nowhere really and make amazing discoveries through 2023. Liontown obviously had the bid from Albemarle that came and then went, but they were building a pretty sizable project themselves. So the next leg, I guess, of the bigger players in lithium in that top chart just shows you that it became a pretty sizable business, but those stocks, I mean, Liontown's obviously come off with the bid as well, but they've come back with the lithium price. And if I strip out anything involved in corporate M&A and just look at the other three bigger players in Patriot, Wildcat and Latin, then they have suffered a bit, but again, nowhere near as much as some of the smaller names, which I'll get to in a second, but haven't quite held up as well as some of the bigger names. I mean, Patriot would probably be the exception to that, and given the quality of and this potential scale of that project in Quebec, it does not surprise me at all. I think just again a demonstration, as we saw with Azure, that if you make, as I said at the beginning, a real discovery of a scalable asset, you will essentially become commodity price agnostic. It'll just be a question of going through the process, which is 3 to 5 to 7 years, depending on where your asset is, to develop it up, put resources around it, put a structure around how it's going to get into production and just go through that process. And if it's attractive enough, like we've seen with Azure, then you just get taken over by a bigger player and they put it in their portfolio and go and do it themselves. So I think from a volatility point of view, it's always been my sort of view is if you're in the bigger names or the assets that have got real scale, if there is periods of weakness on commodity price moves or market weakness, etc., Patriot share price there at the bottom in grey is a good example. They're the entry point opportunities because the asset is still there and it is essentially a commodity price agnostic outcome. Patriot's asset will get built no matter what the lithium price is pretty much. It's just a question of time frame and how long it takes to get there. But when we look at some of the smaller names, this is where they have gone down with the lithium price. And we look at the tops, all the small spodumene guys in Oz and in Canada, with Piedmont and Sayona with their operating asset, Core, which got into production and is now turned off again, and then some of the smaller guys. They found it much tougher, and we haven't really seen a material recovery yet. And that, I think, is partly because it's not a huge institutional basis, so we're not seeing that longer-term view of, I just need to put money to work, I'm getting inflows every day, so I'm just going to hold a sizable position in, say, a Pilbara or Min Resources. It's probably a little bit more what you'd call hot money and retail money, so as the commodity prices fall and sort of the exit from these companies has been quite aggressive. More so on the bottom ones, which is the brine names, where they've all really struggled across the board in terms of where they were, and obviously, looking at the market caps of these things, they were up at sort of $5-6 billion at one point last year when lithium prices were $70,000-$80,000 a tonne. But yeah, have also struggled. And a little bit of that was, I guess, there's hype in the sector at the time, and it was just sort of get into anything in lithium and it was all going up. And there's been a little bit of a reset of expectations as to how long and technically difficult some of these projects might be, or if it's at smaller scale at a lower price environment, then you're going to need to do a joint venture deal with someone who's got infrastructure or something like that, which starts to shift the economics around a little bit. So these are the names that obviously, if the lithium prices start heading back to anything like where they were, will probably do the best, given where they are. But you do need that lithium price to continue to recover. If it stayed where it is for today, for example, for the year, I think it would still be a reasonably tough environment for a lot of these share prices for the next 12 months. But certainly if Chrissy looking for another 10 bagger, you're probably going to find it in something of this ilk as opposed to buying Pilbara at the top end, because those names are already quite well valued as opposed to some of these smaller names. We look across parts of the battery materials space. The nickel space has just been totally transformed in Australia. I mean, we had IGO as a nickel company for a while, who's now lithium. Western Areas got taken over by IGO. Mincor got taken over by Andrew Forrest, Wiley Metals. So we've been left with basically, we just had Chalice and developing its project and Nickel Mines. And Nickel Mines is obviously the dominant player. And one of the reasons the nickel price is as weak as it is, because they're a participant in the Indonesian capacity build out in NPI, which has flooded the nickel market and pushed the price down as much as it has. So there's not a lot of options now in the Aussie space. In terms of things that are in production, they've all sort of disappeared out of the market. You've literally either got Nickel Mines or you have to move to IGO, which is essentially a lithium company. So Nickel Mines is basically the only game in town from a producing point of view at this point in time. But there are some development players out there that I still think have a lot of promise. You look at Centaurus in Brazil, has held value okay. I mean, it's come under a fair bit of pressure like most of them, and Chalice Mining, which Alex has been speaking here, or I think yesterday, it's a bit of a mixed bag. It's not just nickel, it's PGMs primarily as well, which have a similar share price chart, to be honest, in terms of the nickel price. So, those big scale assets like that, you just have to continue to push through and develop it, and at some point the market will recognise that there is a pathway to production that's fundable by themselves, and you'll start seeing a better outcome. So, the smaller scale things have really been the ones that have struggled the most for mine. So if you are looking for high risk, high return type outcomes, then I'd certainly be pointing you towards these sort of spaces as opposed to the bigger names, which remain quite solid. And I'll just finish on I guess a bit more of a positive note, which is the sectors that have just had a really good couple of years. I mean, gold's obviously not in the battery materials space in any real way, but it's a huge part of the Aussie market. We've had a big merger in Australia as well with Newmont and Newcrest, but it's now pushed the whole market cap over 100 billion. So as you can see, in terms of the importance in the Australian market, gold does dominate and does take, I think, away some of the equity interest in some of the battery materials space when things are weak as they are today, because the gold price has just hit new highs almost every day over the course of the last couple of years. So the gold sector is broad as well. There's sort of at least 20 odd producers in Australia, so there's a huge list that you can pick from and provides a lot more interest in the space. And then the other area has been uranium, which has been nothing short of extraordinary. I mean, the market cap of this space is sort of approaching some of the lithium, mid-cap lithiums and gone beyond them. So it's become something that no one really looked at all 3 or 4 years ago to becoming quite material. And there's no sign of it slowing at the moment. I mean, obviously uranium is heavily reliant on government policy in terms of nuclear build-out, but at this point there's a lot of supply risk around where it comes from, particularly historically the amount of production we've got out of places like Kazakhstan. So it does look like a quite an encouraging sort of mini sector that's emerging in the Aussie space that will, I think, continue to get more and more interest, particularly as some of these guys get back into production. Boss has basically just started, Paladin's on the cusp, NextGen's clearly got the biggest and best asset, but it's a few years away from being in production. But we'll start getting a few of these guys actually producing and starting to demonstrate how much money they can make out of actually producing uranium as well, which I think will bring even more focus to the whole market. So volatility's there. It's hard. How do you deal with it? Well, I mean, your friendly Argonaut research team puts out a lot of notes trying to help you navigate what's actually going on. There's 4 of us in the mining space, based out of Perth. We've got an institutional sales desk in Perth and in Sydney. I think George from Sydney is here at the conference this week, who have a lot of close contact. The advantage of being in Perth, as we are, is that one of us is out of the office on the terrace or up in West Perth seeing a management team pretty regularly, to be honest. So getting that face-to-face contact as you're all getting at this conference is something that we do on a fairly regular basis. So if you are struggling with volatility, there's plenty of guys from Argonaut that will be happy to give you a hand to try and navigate it. And with that, I'll leave it there.